Hi guys, so today we're going to be looking at Vertex Pharmaceutical. Its ticker symbol is VRTX, and we're going to be looking at whether this company is a buy in today's market. I believe personally that this company is undervalued and it can be a good long-term play with solid future growth. So today I'll be presenting my stock analysis on this company. If you do enjoy, consider subscribing. It's free and it helps me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we will be looking at today is just a little bit about the company. VRTX is a pharmaceutical company and it specializes in cystic fibrosis treatment, and it leads the industry in this form of treatment. More than 50% of people with cystic fibrosis receive treatment from VRTX, and this number is set to increase to more than 90% as they push forward treatments for both children and gene therapy treatments as well. Over the past year, revenue has grown more than 55% and net income has grown more than 95%. So 2020 was a very good year for Vertex Pharmaceutical. They're also developing a new gene therapy treatment with CRISPR Therapeutics for blood disorders such as sickle cell disease and vaso-occlusive crisis. The market for the new gene therapy treatment that they're developing with CRISPR Therapeutics, the market for that will be consistently increasing because more than 500,000 infants each year are born with this disease. The market will consistently be increasing, and this will fuel future growth. Due to this being a novel therapy, it can cost up to $15,000 for a treatment course, and a 15-50 split between CRISPR Pharmaceuticals and VRTX will no doubt put billions into this company fueling future growth and increasing the top and bottom lines. Recently, however, the stock price has dropped more than 25% from its October highs as one of its upcoming promising treatments was cancelled. And this is what really drew me to this company because it was trading continuously going up 3, 4, 5% regularly per week. But then suddenly over the past few months, the stock price kind of crashed more than 20% a day, then a few more percent over the next few weeks. And over the last few months, it's kind of been like slowly trending higher. So this is what really brought me to the stock, and that's why I believe it's significantly undervalued. Over the past few months, more than 15,000 shares were bought through insider trading. That signifies that people inside the company believe that this company has a good future outlook and is attractively priced. So we'll be going through the financials just really quickly. One trend you'll be seeing kind of pop up through the whole thing is up until 2017, this company's financials were subpar. They were losing money, they were in debt, stuff like that. But over the past few years, since about 2017 to 2018, this company's really started to pick off, and the company's stock price has kind of trended with that. The stock price increasing very highly over the past few years. So the earnings per share was, once again, as I mentioned, up until 2017 was subpar, but then over the last few years, it went to $1, $8, $4.50, $10, increasing very, very heavily, shows good future outlook and good revenue and profit as well. The same can be seen with book value per share significantly increasing. Its operating cash flow, cap spending, and free cash flow, all of them are increasing, basically meaning more money is coming into the company, more money is going out of the company, and more money is staying into the company over the past few years. This trend is very promising as it shows that the company is really finding its footsteps, and the long-term trends of this looks very promising for the company. The net margin we can see currently is 44 or 45%, which is very extremely good to, as a matter of fact. This is similar to the net margin you see for a tech company like Apple, which is quite low capital intensive, but a company that's investing very heavily into developing new therapies and creating new drugs. That's a very, very good net margin that this company has, which is good, promising. Return on equity of 40% is also very promising, shows that the company is using its money to a very high standard. And this is a good outlook for the company for long-term investors. Its interest coverage of 52 years is solid, showing that this company can pay off interest for the next 52 years without worrying having to pay off debt. But even if they do have to pay off debt, their debt to equity ratio of 0.07 is very conservative, meaning that their debt is very small portion of the equity in the company. So if you look at the PE ratio, you could see the trends over the past few years that it's actually trending downwards as the stock price increases, which is a strange phenomenon, but that basically means that the stock price is growing at a lesser rate than the earnings per share is growing. In fact, at a much lesser rate than the earnings per share is growing. and that signifies that the company is actually trading at a pretty fair value as of right now. And just without looking at past trends, a PE ratio of 20 is extraordinarily cheap compared to the market and the industry, and we'll be going through that later. Its PEG ratio is actually pretty solid. All of those over the past few years has been below 1, basically showing that this company is growing at a very fast rate, and it looks to continue this into the future as well. So just some comparisons. According to Simply Wall Street, this is more than 44% undervalued. I'll be going through my technical analysis in the next slide, and we'll be looking at an entry price and where this company will be going through in the future. But I agree that this company is undervalued as of right now. As previously mentioned, its PE ratio of 20 is extremely cheap if you compare it with the biotech industry, which has a PE ratio of 35, which is more or less in line with the US market of 33, showing that this company is a cheap buy compared to both competitors and the market. And the PEG ratio of 0.33 shows that the near-term growth of the past few years has been amazing, and the long-term growth looks pretty promising, especially with the CRISPR Therapeutics partnership, and that will bring in more money to the company. The revenue is set to grow at 11% year-on-year compounding. The earnings are set to grow at 12.5% year-on-year compounding. But both of these growth rates do not take into account new therapies or drugs that the company will be developing. So let's say that they do develop more drugs, these numbers can only increase. So we might be looking at a 15% revenue year-on-year compounding or a 17% earnings year-on-year compounding. But based on current trends, an 11% or a 12.5% is very promising, outplaying the S&P 500 by a significant amount. The earnings per share, once again, based on current trends, has a solid growth rate of 11%, and especially with the company at this high size, with very good revenue, very good financials, an 11% year-on-year growth is very solid. So we'll be looking at the technical analysis here. Over the past year or so, looking from about November of 2019, you can see this company has been pretty volatile. So you can clearly see around March here, you can see the stock market crash. Then it went really high, July, September, traded downwards a little bit, but not too much. And then October, it crashed from about $280 all the way down to $200. And then once again, this company's been trading higher, hit 240, and once again crashed back down to 200. So you can clearly see that there's a pretty solid support line at about the 200 to 215 mark. Anytime this company really reaches it, it goes back and increases tremendously. The first time it went to 240, the second time it crashed, it went all the way to 300. The next time it crashed, it went to 240, and once again we find ourselves at the line of support. And here, once again, it looks promising. This company is looking at a very high uptrend, so I would recommend a buy as of right now. We can clearly see that the company's 20-day and 50-day simple moving average is below the 200-day simple moving average. This may signify a downtrend, but we can see that this line of support has been shown for a long time, and it hasn't really fallen below this price for over a year now. So I wouldn't be too worried about it falling any lower than $200. So I would recommend to buy it $215. And analysts also expect that there'll be 44 to 55% uptrend. So we're looking at a fair value estimate at about $350. So just some final words about this company. It leads in the niche market. It operates in CF treatments, and it's also diversifying into blood disease treatments as well with its partnership with CRISPR. It's trading at a pretty decent value right now. It's 25% down from its October highs, and it has a few very promising drugs coming up. It has good long-term uptrends, and it leads the niche market. And it has a P ratio of 20, which keeps dropping even as the stock price increases, and has a PEG ratio of 0.3, showing exceptional growth. Although the future growth is solid, it doesn't have the amazing growth you would see, let's say, from a company like Tesla. So I would recommend you can buy this stock if you're looking for a safe but solid future growth bet. But as always, do your own due diligence, and thanks for watching. Bye.